Reserve cut interest rates 25 basis points to a new range of 2.0 to 2.25%. This move was largely telegraphed by the Fed and priced in by markets. We'd seen bond markets drive yields lower, driving the yield curve very flat and even inverted in place. And we see a significant rally in risk assets anticipating the Fed move. So the markets put the Fed on notice that growth had been slowing and needed to act. I think this move is symbolic in many ways. This is the first rate cut we've had since the Great Financial Crisis in 2008, when the Fed took rates from 5.5% down to zero and kept them there for a significant period of time to help support the recovery. Oftentimes the Fed doesn't act just once, so we can anticipate some more moves in the future, and the markets are pricing in 2 to 3 moves at this point. I think the way I characterize this move really is this is an insurance cut done in good times to try to sustain the expansion and not so much to avert a crisis per se. All in all, bottom line, I think, is the Fed is acting in a preemptive way. It's a preemptive strike to try to get ahead of the curve and prevent and guard against the outlook from worsening. Investors are sort of grappling with what this all means. We've seen an abrupt shift in the Fed's reaction function, and investors are wondering what this is about. Going back to 2018, the Fed had a sort of de facto hiking bias. They were normalizing interest rates, they were reducing their balance sheet, and then they pivoted, and they went to a pause, and they said they were going to be patient, they were going to be flexible, and data dependent, based on the turmoil we saw at the end of 2018. And now they've completely shifted gears to an easing directive. I think it's important to stress it's not just the Fed making a move here. We're seeing a global easing cycle underway. We've seen as many as over a dozen central banks ease over the last 3 to 4 months. So this is a global phenomenon going on right now. I'd say the big picture takeaway right now is I think the Fed may have over-tightened the cycle, and they need to course correct. They may have misjudged the underlying neutral rate of interest, where interest rates don't stimulate or curb economic activity. So not only did they perhaps misjudge that, but I think they also misjudged the underlying strength of the economy and the inflation pressures from 2018 that didn't necessarily carry over to 2019. This insurance cut was a prudent move given the shifting landscape and the change in economic and market conditions. Our outlook is unchanged. We had fully anticipated this move, as markets did, so this doesn't alter that view in any way. Our base case scenario right now is the economy is in pretty decent shape. We think we're in this late cycle expansionary phase right now. And we think there's more runway to the expansion. We just don't see the typical imbalances you'd see at this point in the cycle. So the chances of a garden variety recession, we think, are remote at this point. And while there is difficulty and challenges in certain areas like manufacturing, trade, and capital investment, we're seeing strength in the backbone of the economy, which is the consumer. Consumer's in terrific shape. The banking system is in solid shape. So we think the odds of these events right now derailing the economy are quite low.